Hello friends, welcome to my channel. If you are looking out to understand what is property plant equipment from a very basic level as per Ind AS 16, then this is the right place. So in this video, I'll be covering 50% of this standard. The remaining will be covered in a separate video later. Now let's see the overview of the topics that we'll be covering in this video. To start with, in order to understand the definition of property plant equipment, it is very necessary to understand the distinction between revenue expenditure and capital expenditure. The next, we are going to understand the initial costs and subsequent costs. That is, what are all the costs which comprises in the property plant equipment definition, and what are the criteria to be fulfilled in order to identify a particular item as a property plant equipment. Finally, the measurement components of property plant equipment. These are the things which you are going to understand in this video. The remaining parts of Ind AS 16 will be covered in subsequent videos. As I said earlier, we need to understand the distinction between revenue expenditure and capital expenditure in order to well appreciate the definition of property plant equipment. You will be able to appreciate this better once we move on to the definition of property plant equipment. In simple terms, any expenditure, if the benefit is derived from that expenditure for more than one financial year, then it gets identified as a capital expenditure. If the benefits get expired within a financial year, then it is a revenue expenditure. There are four major criteria which we need to look into in order to distinguish between revenue and a capital expenditure. Those are operating activity of the business. I'll explain each of these with some examples. So the first criteria is the operating activity of the business. That is the activity in which the entity is involved in. For example, if there is a furniture dealer, the stock will be furnitures. Though furnitures are widely being used as fixed asset, in case of a furniture dealer, it need not be a fixed asset because he deals in furnitures, that is, he purchases and sells the furnitures. So his operating activity itself is furnitures as stocks. So in such case, furnitures are not fixed asset, they are current assets, that is, they are stocks for that particular entity. On the other hand, if we look at school as an example, school purchases various kinds of furniture like tables, chairs, and a blackboard or a projector, or so many investments it makes. The benefit it derives from such investments are lost for more than one financial year. The operating activity itself is to teach the children. So in such case, all the assets which I mentioned, like the tables, chairs, or the furnitures, or the projectors or the blackboard, all these get categorized as a capital expenditure. Secondly, periodicity of incurring the expense. In case of a manufacturing concern, the purchase of machinery is a capital expenditure because they incur it not every time, not very often. They incur it in one particular financial year. Of course, those machines get used for more years over its useful life. So the periodicity of incurring such investments in or spending on the machinery is not frequent. So in such cases, they are capital expenditure. And in case of other expenses like payment of wages, salaries to the employees, these are more frequent and recurring within a financial year. In such cases, these are revenue expenditure. Third reason being impact on productivity or future revenues of the business. Let me give you one example based on repairs and maintenance. A factory incurs repairs and maintenance on the machinery, but just because it is a repairs and maintenance, we cannot decide whether it is a revenue or capital expenditure. We need to go a step further. That is, if the expense which I incurred on repairs and maintenance results in the capacity of the machinery, if the machine operates at its 100% capacity, then in that case it is a revenue expenditure. That is, I have a machine, it got broke down due to some reason, and I incur in repairs and maintenance. The expense which I incurred resulted in restoring back the machinery to its original capacity, that is, back to 100% capacity. In such case, there is no impact in its future revenues or in its productivity. In such case, it is a revenue expenditure. However, if I incur some kind of repairs and maintenance expense which results in increasing or maximizing the capacity of the machinery such that it was operating at 100% capacity, it started to operate at 120% of capacity. That is, in one day I used to produce 100 units at 100% capacity. I started producing 120 units at higher capacity, right? So in such case, the 120%, the additional extra 20% of the increase in the capacity of the machinery results in increased future revenues, in which case it gives the benefits for more than one financial year. That's the reason why that gets categorized as a capital expenditure, though it is a repairs and maintenance. And final reason or a criteria is materiality. Management judgment is a major factor in determining what amount is material. It depends on the facts and circumstances of the case. It's a management which decides what is material for its own business. But how to determine what is material? The omission or misstatement of any such higher amounts results in serious impact on the true and fair view of the entity, financial statements, or if it gives a wrong picture to the users of the financial statements in taking decisions, then such amounts are said to be material, and it's purely it's a management decision who are to decide on what is material. So in most cases, all material amounts tend to be a capital expenditure, so it is the materiality. All if it is below the material amount which is decided by the management, in such cases they will be written off in the profit and loss account, which means that those will be a revenue expenditure. To once again recap once, the major criteria which we look into in order to distinguish between a revenue expenditure and capital expenditure are the operating activity of the business, the periodicity of incurring the expense, the impact on the productivity of future revenues of the business, and finally the materiality of the amounts. And in all these cases, in simple terms, if the expense is being incurred and if the benefits are derived for more than one financial year, then they are said to be capital expenditure. If not, then they are revenue expenditure. So as I said earlier, the understanding of the distinction between revenue and capital expenditure is very important in order to understand the definition of property, plant, equipment. Why I said so is because a property, plant, equipment investment is basically a capital expenditure. You will be seeing that further when we see the definition in detail. So in common parlance, we call property, plant, equipment as fixed asset. That is the old Indian standard. We call the AS10 is nothing but fixed asset. So that is what we call it as property, plant, equipment as per Ind AS 16. So the definition says any tangible item which is held in production or supply of goods or services or rentals to others or administrative purposes and which is expected to be used for more than one financial year gets identified as property, plant and equipment. To understand what is tangible item, any asset which we can touch and feel. Intangibles, like patent, copyright, trademark, there is a separate standard which gets covered, which discusses about it in detail. So in this standard, we'll be seeing only on tangible items. Such tangible items which are held in production or supply of goods or services, which means which are being used in manufacturing or trading or service-based entities, these assets will be used, or if they are used in rentals to others or administrative purposes. When we say rentals to others, it doesn't include investment property because there is a separate standard which deals on investment properties. Investment property means rentals of land or building. So any rentals other than land or building gets covered under this standard. Administrative purposes mainly includes, or it rather includes, selling, distribution, finance, accounts, personnel, all these categories. So it's not necessary only if a tangible item is held for these purposes, it should also be expected to be used for more than one financial year, which means it is basically a capital expenditure. So in the previous slide, we discussed about what is property, plant and equipment. Just to emphasize on the definition, any tangible item which is used in the business and which is expected to be used for more than one financial year. So the criteria to be, it has to be a capital expenditure, that is the benefits are to be derived for more than one financial year. It's the major criteria. So that is a property, plant, equipment. In this slide, we are going to understand when to recognize a particular cost as property, plant and equipment. So there are two conditions once again to be satisfied. One is future economic benefit has to flow. When I say future economic benefit, it has to be financially measured. These two are the major criteria to identify that property, plant, equipment as cost or to capitalize it in your books as asset. We already know that if we are going to show it in a financial statement, obviously it has to be something which can be measurable in terms of financial sum. Only then we will be using it in our financial statements, otherwise it won't be. So the future economic benefit we have already discussed in the revenue expenditure and capital expenditure distinction itself, as when the economic benefit is said to be derived for more than one financial year, it is a capital expenditure. That is different. But here what it says is it has to have some economic benefit to the entity. That is, it should not be it should not be something which is not related to the business or not related to the trading of the entity itself. However, in Ind AS 16, we are not going to discuss about non-current assets which are held for sale or discontinued operations, or any agriculture related assets, or any exploration or evaluation of mineral sources or mineral rights or mineral reserves, and as we saw in the earlier slide, any investment property related assets. All these are not going to be discussed in this standard because there are separate standards which deals with these. And when we are going to recognize a particular cost as property, plant and equipment, the management is given the decision to aggregate similar kind of assets into one and apply the materiality concept in order to identify it as a property, plant and equipment. Next, we will see what includes in the cost of property, plant, equipment. There are two major costs which we need to consider while capitalizing property, plant and equipment. One is initial cost, which includes the cost to acquire a particular asset, or it includes the cost of constructing an asset. That is, in order to build a building, we may invest in so many resources for constructing a building. So all the summation of all these costs is the cost of construction, which need to be capitalized if it is a fixed asset for you, if it is a property, plant and equipment. The major criteria for the initial cost to be capitalized as property, plant and equipment is future economic benefit should flow from that particular asset, and obviously the benefits which we derive from that particular asset won't get expired in one financial year, and it flows for more than one financial year over its useful life of the asset. Even if a particular asset provides you the benefit in an indirect way, but still if it adds to the future economic benefit, then it has to be capitalized as property, plant, equipment. For example, businesses or companies, they install safety measures, firefighting equipment. In case of some manufacturing concerns, they may install some filters which are necessary to ensure that they abide by the environmental issues are not faced due to their manufacturing activity. In such cases, they need not directly result in an increase in the revenue, but they indirectly add value to the business. So in such cases as well, these costs are to be capitalized as property, plant and equipment. The subsequent costs mainly are of few types. I will give some examples. If they are repairs and maintenance, if they do not result in an addition to your economic benefit, or they do not result in increased capacity of your property, plant and equipment, in such case they are to be charged to P&L. If they are recurring replacements and they meet the criteria conditions to be satisfied for being recognizing it as a property, plant equipment, even in such cases, if though they may be recurring replacements, but they may be replaced once in 5 years, like such cases, I'll give an example. Aircraft, an aircraft company, they are supposed to overhaul their aircraft. Even if they are in a working condition, they need to periodically work on testing and overhauling of their aircrafts. So in such cases, there is an inspection which is being conducted maybe once in 5 years. There is a huge expenditure for these inspections. These inspections may be just an incurring of some expenses for repairs, or just checking whether these aircrafts work properly. They need not actually result in any enhanced capacity as such, but still they need to be recognized as some cost to be capitalized, because their benefits are being derived for more than one financial year, right? If inspection is being done in one particular year, then it means that that particular aircraft is fit to be used for next 5 years. So it gives the stability, or it certifies the ability of the aircraft to be used for next 5 years. So in such cases as well, there is indirect flow of economic benefit, in which case they need to capitalize the inspection costs. Because these are recurring inspection costs, they need to capitalize it and ensure that the earlier capitalized inspection costs are being de-recognized from the books once the new inspection cost gets capitalized. I hope I was clear in explaining this. If in case of any doubts, you can leave it in the comment section. Next, we are going to see the measurement costs. That is, while measuring the cost of property, plant and equipment, we need to take into account what are all the costs to be included and what are all to be excluded. What we are discussing in this slide is at the time of recognition. Once the property, plant and equipment has been recognized, we will separately see on how the measurement has to take place after recognition on a yearly basis in a separate slide. So in this slide, we are learning on what are all the costs to be included or to be capitalized as property, plant and equipment. Those include the purchase price, basically that is the basic thing while capitalizing property, plant and equipment. So the first is the purchase price, which is inclusive of the taxes which is being paid and after discounts. So the net amount which the company had incurred in bringing the asset to the present location and condition. Whatever we discussed in the earlier slide is the initial cost and subsequent costs. Those are the types of costs to be considered in property, plant and equipment. Here what we are discussing are the components of the costs which are to be capitalized under property, plant and equipment. So one is the purchase price, whatever is being incurred in bringing the asset. It includes all the costs to bring the property, plant and equipment to current location and condition. This means that all direct attributable costs are to be included, like initial acquiring, the cost of construction, installation, testing, professional fees, whatever costs which were being incurred till the asset is being brought to the present location and condition, all the costs are to be capitalized. Next is major cost is borrowing cost. What is borrowing cost has been separately discussed in Ind AS 23. However, I'll briefly explain on what is borrowing cost. It is the interest on the borrowed amount for a qualifying asset. So, what is a qualifying asset? Any asset which takes more than a financial year for its intended use. So, that is an asset that takes substantial period of time to get ready for its intended use or sale. The substantial period has been given in clarification note that it is period of 12 months. So it takes more than a year to get ready for its intended use as a qualifying asset. So for such asset, if an amount is being borrowed on acquiring such an asset, and if interest is paid on those, then they also deemed to get capitalized as borrowing cost. Of course, these are being discussed in detail. There are various other intricate points included in that standard in Ind AS 23. Here, when I said that all directly attributable costs, it includes all costs to bring the particular asset to present location and condition. The capitalization of the cost ceases once the asset reaches the current location and condition once it's ready for use. So any other cost which is incurred after it's brought to the location and condition for its use are not to be capitalized, the capitalization ceases. When I said the costs, that is the directly attributable costs, I will give one example. For example, is constructing a shopping complex. In order to construct that, I need to relocate the residents who are being present there in order to get the space area for constructing the shopping complex. In such case, I have to compensate the residents who were there in that particular area. So whatever costs I incur in providing a relocation for these residents get identified as directly attributable costs, which need to be capitalized. More unique kind of expenditure which gets identified as to be capitalized under property, plant, equipment is any costs which are being incurred in order to prepare a site, like dismantling or restoring the site where the property, plant and equipment is to be installed. So if there is an obligation for the company or the entity to dismantle or restore the site where the property, plant and equipment is to be installed, then in such cases whatever costs are being incurred with respect to that obligation has to be capitalized, because it is this obligation is related to the property, plant and equipment. Next, we will see the costs to be excluded. While capitalizing the costs for property, plant and equipment, we will not consider any costs related to new facility or staff training, advertisement or admin overheads, because these are not relating to the fixed asset on a long-term basis. These more or less they are on a day-to-day basis. They influence or they are related to the operating activity of the business. In such case, they will be charged as revenue expenditure only if such expenses are also can be identified as they have a direct relation to the fixed asset and they give a long-term future economic benefit. In such cases alone, they will be capitalized. Once again, in case of self-constructed assets, abnormal expenses won't be considered for capitalization. Like if there is abnormal wastage of any resource, or like if it is a raw material or labor or any overhead, if there is any abnormal wastage, such expenses are not to be considered in capitalizing as property, plant and equipment. So far we have learnt so many things relating to property plant equipment. So there's a small question which I put forward just to test your knowledge on whatever you have learned so far. So this is the question. Vega Mall constructed a new floor to accommodate Amoeba Gaming Zone. Upon this construction, it is expected that the overall visitors to the mall to increase. So should the cost to construct this floor be capitalized? This is the question for you all. You will get the answer for this question in the next video. To quickly recap on whatever we have seen so far. First, we saw the distinction between revenue and capital expenditure, as I reiterated that it's very essential in order to understand what is property, plant and equipment. Next, we learned on when to recognize a particular cost as property, plant and equipment. Then we saw the types of costs that get recognized as property, plant, equipment. That is the initial costs and subsequent costs. What are the types of subsequent costs and how they need to be recognized. Finally, we saw the components of the costs to be considered. I have asked a short question on how the accounting treatment should be in the test your knowledge section. So you can leave your comments in the comment section upon your answers or any feedback relating to this video. In the upcoming video, we'll be seeing on measurement value at the time of recognition, measurement after recognition, and impairment and derecognition. Finally, the accounting entries for all these sections will be covered in the next video. Hope you liked the content which was presented in this video. Do leave in the comment section any doubts or feedback regarding this video. If in case you would like to learn any specific area under finance, do leave them as well in the comment section. Please subscribe and click the bell icon so that you won't miss an update on the upcoming videos. Till then, this is Srinidhi signing off from you all. Thanks for watching.